Hi guys, welcome to Investing with GYK, and today we'll talk a little bit about the Beijing Capital Airport thing again. Um, so I did a video on this quite a while ago. It crashed like 25% from due to there was a reduction on there's a reduction on their revenue because CAAC or whatever the civil aviation China Civil Aviation Committee or something like that, CCAC or something. Yes, some alphabetical soup. Decided that public publicly traded airports are no longer entitled to one of the fees that they collect. So the thing took a big hit, and then it will take effect in 2019. And it just took another dive. So at that bottom, I bought. Then I took another dive, and I bought more. Uh, the dive was that because the new airport, the Dashing Airport, which everybody knew was going to be there. It was the building started in 2014, and now they decided how they want to structure the migration. So they were like, okay, so if you migrate by 2020, we'll like all in one go as an airline. We'll give you additional like 40% allotment, and if you do by 2021, we'll give you like 40% additional allotment and 30% more and something like that. Right, so it's to encourage um, the migration of the airlines, and the airlines that have to migrate are the big two are China Southern and China Eastern, and so those account for approximately 40% or slightly less in terms of passenger traffic. The revenue decline probably won't be as much because most of their traffic is domestic. But anyways, so I looked at this stuff, and essentially here are some valuation charts you can take a look. PE, which will no longer be applicable next year because the earning will go down, probably be by quite a bit. So ignore that. Your PE probably will jump to like 15, even maybe. PB is currently at 1.18. When I bought actually here, it was almost like 1. It was almost 1 when I bought at on the day it crashed. Then it kind of came up a little bit. PS is all-time low. The blue line is all-time low, and you can see it's 8th percentile. And in terms of PB though, it has been cheaper. But at that period of time, they had a lot more debt than they have now. They almost got rid of their debt now. And dividend, it's on the high side, historically speaking, but next few years, maybe it will drop. Anyway, so that's valuation. That's one of the reasons I bought them. And also, they were cheap. These guys have an EV. Well, I think when I bought it had an EV of 25 billion Hong Kong dollars or something like that. So that is, let's do it, 25 HKD to KD to CNY, 20, let's say 22 billion CNY, Chinese yuan, in EV. So that is essentially all the money that sinks into it. The comparable number for the new airport is the total investment, which is 80 billion. Right? So you're getting it actually at almost like a 70% discount to the new airport, which is further, which will be similar in size too. This thing's designed for something like 80 something million people, passengers. Currently it's operating at more than peak. Oh, in fact, it was like some airlines were trying to expand in Beijing capital, but the aviation board said, "Oh, your on-time rate is so bad, we cannot allow the expansion." So you can see there's actually a lot of demand that cannot be satisfied at the moment. All right, so I also did a video with Sven. There was some bullish statement that you can check out there, but in here, I'm gonna mainly focus on all the negatives. All right, so let's think how such a company can screw over small shareholders. Right, so that's always a danger, especially if you invest in a place where the respect for capital isn't that strong. China, especially to the north of China, which Beijing is somewhat to the north, there's a saying that the further north you go, the less people respect contracts, the more bureaucratic it gets, and then the more heavy-handed the government is. So in this case, the government is definitely very heavy-handed. They're like, okay, you guys need to move to the new airport, and I'm gonna give you a huge stick and a huge carrot in order to entice you to do that. So some of this is one way, right? We just saw that. But what else? So one thing that was somewhat controversial is this GTC stuff. What is GTC? It's just Ground Transport Center. I don't know why they call it GTC. So it's unnecessarily alphabetical soupy, right? So it's just a parking lot with some random stuff. Okay, so what is GTC? GTC was built in 2008. It was some parking structure and other stuff. There's a definition of it. But in 2013, the GTC by then was still owned by the parent company. So the parent company said, okay, we will lease it to you and then you will run it. So to Beijing Capital Airport, right? And the lease was 3 years. And the way they do it is obviously the leasee is going to collect all the revenue and be responsible for a lot of the costs. So here is how I decided. It says the child company, so the one that's publicly traded, is going to be responsible for security, management, construction, maintenance of equipments, energy, labor. Actually, this is also management. This is property management. I don't know what the hell the difference is, but taxation and more taxation and insurance. That's the cost on the child company. And the parent company, which is not public traded, not the one that we bought, but is a majority shareholder, says it will be depreciation, which is a non-cash item. Essentially, it's already sunk, so it's pointless. Interest, so financing cost, which again, it makes no sense for the lessee to the leasee. Damn it, I don't know. The one that leases to pay for it, right? Because they don't own it. And some property insurance. Okay, so that's that. That's that. Basically nothing. It's essentially just the property insurance part. And then the profit sharing is where the somewhat fishy stuff starts to come in. Says if GTC is lost money, then the child company sustains all the losses. And if GTC produces a profit of less than 20 million yuan, which is something like $3 million, then the child company gets 20% of the profit and the parent company get 80% of the profit. Okay, and if the operating profit is higher than 20 million but smaller than the cost to the parent company, which is completely weird in this case, but whatever, says anything above 20 million yuan, the split is 30% to the child company and 70% to the parent company. And then, you know, if it exceeds the cost of, if the profit exceeds the cost of the parent company's cost, then on top of 3, on top, so whatever is left, the thing that the portion that exceeds the cost is 40/60. Essentially, the parent company will get a majority of the cost, the benefit here. Well, the good thing is that there isn't a lease there isn't a lease payment except the profit sharing part and the management cost, which you have to bear anyways. So that's that for the old lease, which is that's how they structure it. Essentially, the child company will run this thing, but the majority of the profit goes to the parent company. Now, in 2017, they decided in here. So this is a 2000. Well, in 2017 they decided. This is 2018. They actually they concluded the transaction, but essentially, here it is. The parent company holds 56% of the shares, so they're majority, they're absolute majority holder. They don't have 67%, above which they can unilaterally change. I think you can change company charter or something like that. There was some special percentage of the 31% for veto or something, 37%, 34% for veto or something, 50% for majority, and then 67% for absolute majority. I don't, something like that in Chinese corporate law. But anyways, that's an aside. So in here, what the important thing here is they're going to pay 4.5 billion 4.5 billion yuan. And in like two parts. The first installment is $2 billion. So that's the first payment, 2 billion yuan. And then the rest being paid is another 2.5 billion, but over a period of time. And this is how they decided to value it. It's really unimportant. Some of the assumptions are like their asset valuation included saying things like the price. Yeah, like the price of the land would fluctuate up to 10% per year. But That's irrelevant because what the company will be stuck paying is 4.5 billion yuan. Here it is, maximum consideration 4.5 billion yuan. Okay, so is that an overpayment? Well, we can consider a couple of things, right? First of all, they actually tell you the year-ended net profit for this GTC stuff is negative. But then you say, wow, why they pay money for negative, a negative asset, negatively earning asset? The thing is, this is a real estate. And when you calculate accounting profit, you put the depreciation in. And to be honest, if you have the building maintained relatively well, they last a lot more than 30 or even 50 years. So it's not really what you should be looking at. You should be looking at AFFO. But they don't disclose that. AFFO is how you value RDITs here in US, and that would be more reasonable here. But so based on this number alone, you would think, okay, this is insider dealing, self-dealing, very, very bad. But then you can think of what they're getting in terms of GTC. So here's how they valued it, some stuff like that. But you can take a look yourself later. But they decide what GTC is. GTC and GTC assets. So GTC itself is a car parking building that is located in the south side of Terminal Number 3 of Beijing Airport, total gross area, blah, comprising of 4 floors above ground level, being taxi queuing lot, car park, commercial area, and airport express station. So essentially, you have parking lot. With this thing basically is a parking lot, and like a glorified one, because now you charge taxi money to get into the airport, and the commercial area, which might turn out to be somewhat more profitable because now you can set up shops there. And the airport express station, well, they will get a cut from that as well, presumably. And this stuff, GTC assets is basically just, the land and the building, the whole shebangs, basically. Now, are they overpaying for this? I can't find how much does a car park cost, but I can find how much a typical office building costs. So first of all, you find out where the airport is. It's in this district called Shunyi, and in this area, within Shunyi, it's close to the center of Beijing. Right, so it should sell. If this was a normal office building, it would sell at a higher price compared to the rest of Shunyi. So then I looked at how much does it cost to buy things in Shunyi as an office building. So the average is, well, I don't have an average, but you can look at it. So you got some 25K, 37K, 25K, 20K, and then 15K, 14K. And and this one is probably even more representative because this is called 空港中心, essentially like airport center. Right? So it's presumably close to the airport. And this one is Hangcheng Guangtang. That sounds like close to the airport as well. 23. They're all close there. And 15, 14. So you can see the minimum they pay is 14K, essentially 14, 13. So there's 13K for each square meter. And obviously, this does not grant you the right to make modifications, right? Because this is within a building, so you don't buy the entire building or the land. So for the money that is paid, 45 billion CNY, you divide that by the number of square meters, you get to about a wait, 45. Yeah, so you pay, I think it's 45 billion, right? Let me just make sure it is. I'm not making numbers up. Whoops. Wrong. Paste. Oh, 4.5 billion. Sorry, I'm going crazy. So yeah, so each square meter is being sold at 13K. But we're not looking at apples to apples comparison. This is location-wise, yes, they're similar. This is probably on the better side of Shunyi, but this is a car park. This is not an office building. Portions of it is, but not the entire thing. But again, and at the same time, you're getting the entire building plus the land underneath it. So you're getting something more than what we just saw here. So you have to decide whether this is a good deal. But I would say it's probably not a fantastic deal. Probably on the bad side. And this is one of the ways you get screwed over by a majority shareholder in a company like this. So just keep that in mind. And I think this so far is the biggest risk I see. You know, I was talking to Sven about self-dealing, and this is borderline like bad form self-dealing. So, you know, keep in mind this is one way they can get the cash out of this company and in order to benefit the parent company. But it's really cheap, though. Like the valuation is really cheap, and if anything goes better, I think this company is still going to do fine. And the other thing is, because this company has done some of these things, remember the lease thing, and then now the buyout, the valuation is just not as high as Shanghai Airport, which hasn't done any of those weird things. So the median was 17 for PE, and the median was 1.3, 1.4 for PB. But Shanghai Airport is much higher in valuation, probably something like 20 median PE and like 2 to 3 median PB. So, you know, keep that in mind if you decide to buy this stock. Personally, I like it a lot. I understand I'm dealing with some crooks that would from time to time screw you, and I'm prepared. Yeah, so that for next 3 years, because nothing is going to be good for this airport. For the next 3 years might be a good time to accumulate some shares. And if they keep screwing over small shareholders, they would get their historical valuation, probably is again back to like 1.3, 1.4 PB. So you're looking at a 30% valuation bump, and then earning bump by 2020 something, 2022, 2023, or maybe 2024. So like 5 years ahead, the earnings should be back to where it is now, if not higher. But yeah, so this is one of the things that I think has a great moat, but bad management. And if it were any other business, I would not consider investing, but it's something that location is something you cannot compete with. And that's why I still like this one a lot. All right, enough ramblings. See you guys next time.